For ages, stocks and bonds were the bedrock of building wealth. But over the last decade, this whole new thing called crypto has exploded onto the scene. Yeah, it's volatile, it's powerful, and it has the potential to seriously juice your returns. But, and this is a big but, only if you use it with some serious care and discipline. So today, we're going to build a really clear step-by-step plan for a hybrid portfolio that hopefully gives you the best of both worlds. I mean, this is the question, right? This is what every modern investor is wrestling with. How do you get a piece of that explosive growth you see in digital assets without, risking your entire financial future? It's that classic tug of war between greed and fear. And the answer isn't to pick one or the other, it's to find a smart, structured balance in the middle. And that's exactly what we're going to do here. This isn't about hyper yelling to the moon. We're going to dig into the hard data, look at 3 different sample portfolios you can actually use, and walk through how to put them into action. And maybe most importantly, we're going to cover the crucial tax and custody traps you absolutely have to avoid. All right, let's get into it. So before we even dream about putting a single dollar into this, we have to really wrap our heads around the raw data. The numbers behind how crypto behaves are, well, they're unlike anything else in traditional finance. And understanding them isn't just a good idea, it's totally non-negotiable. Now, check this out. The scale of the difference here is just wild. We talk about the stock market being volatile, right? Well, the S&P 500's volatility usually hangs out somewhere under 20%. Crypto is in a completely different league. Bitcoin's volatility, it's often clocking in at over 42%. That is more than double the risk of holding big American companies. These insane price swings are just part of the deal. And this number, man, this shows you exactly what that volatility can mean when things go south. This represents Bitcoin's biggest drop ever, from its highest peak to its lowest valley, a drop of over 74%. To put that in perspective, the S&P 500's worst drop was about 33%. You have to be mentally ready to see your crypto investment get slashed by more than 2/3. It can happen. So you're probably asking, why on earth would anyone sign up for that kind of risk? Well, this is why. For all of that terrifying volatility, the historical returns have been just astronomical. Over a recent 10-year stretch, the S&P 500 did great, a fantastic 13.2% return per year. Bitcoin, 81.6%. That's the mind-blowing reward you get for stomaching all that massive risk. It is the fundamental trade-off right at the heart of crypto. Okay, so for a long time, the big argument for crypto was that it was a great diversifier. It didn't move with the stock market. But that story has changed. Since around 2020, its correlation with stocks has gotten much higher. And here's the kicker. That correlation spikes at the worst possible time, when the market is in panic mode. When stocks were falling because of rising interest rates, crypto often fell right alongside them. So you can't count on it to be your safe haven in a storm anymore. You have to think of it as a high-octane growth engine, not a safety net. So, with all that shocking data in mind, how in the world do we actually build a portfolio with this stuff? We can't just toss some crypto in the mix and cross our fingers. We need a strict set of rules, some core principles to manage this wild ride and keep our strategy from going off the rails. So, these are the golden rules. First, keep your position small. We'll talk about how small in just a sec. Second, diversify inside of crypto itself. For most people, that just means sticking with the big ones, the most established names like Bitcoin and Ethereum. Third, if you want the simplest, safest path, go with ETFs. Fourth, set rigid rules for rebalancing. And number 5, the absolute most important rule of all, and it is non-negotiable, never, ever, ever invest more money than you are truly, genuinely prepared to lose. Okay, remember this number, 5%. You can think of this as the tipping point. All sorts of research from across the financial world, from firms as big as BlackRock, they all point to this level. It's the threshold where a crypto allocation starts to seriously change the entire risk profile of your whole portfolio. And here's the math that backs that up. The second you go past that 5% mark, crypto's intense volatility can just completely overwhelm all the other smart diversification you did with stocks and bonds. In fact, one study showed that bumping your crypto allocation up to 10% can jack up your entire portfolio's volatility by a whopping 41%. This is exactly why the institutional sweet spot, even for aggressive growth, is a much more measured 1 to 4%. Okay, with those rules locked in, let's get practical. Let's look at 3 different portfolio models you can use as a starting point, each one built for a different comfort level with risk. All right, let's break these down. First up, the conservative model. 45% in bonds, 50% in stocks, and that key 5% in digital assets. This is that sweet spot we talked about, designed to boost your returns without going crazy on the downside risk. Next, the moderate model. Here you pull back on your bond safety net to 30%, keep stocks at 50%, and dial up digital assets to 20%. And finally, there's the aggressive model. This is for people with a very, very high tolerance for risk, only 10% in bonds, 60% in stocks, and a massive 30% in digital assets. And just a word of warning, with this last one, your portfolio's performance is pretty much going to live or die based on what that crypto chunk does. So, you've picked a model that feels right for you? Now what? How do you actually go out and buy this stuff and then, manage it? This is where the rubber meets the road. You've basically got two main paths. The first one is the Spot ETF, or exchange-traded fund. This is by far the easiest and safest way to go. You just buy it in your normal brokerage account. Your tax paperwork is way simpler, and you have zero risk of getting hacked and losing your coins because the fund manager handles all the security. The second path is self-custody. This is where you hold the private keys yourself in a digital wallet. The big advantage? Total control. When exchanges like FTX collapsed, people who held their own keys were totally fine. The trade-off? The security risk is now 100% on you. If you lose your keys, that money's gone. Forever. Okay, listen up. This might be the single most overlooked but most critical part of managing a portfolio like this. Rebalancing. It is not optional. Let me say that again. It is not optional. Let's say you started with a 5% target for crypto and it has a monster run and suddenly it's 10% of your portfolio. That's awesome, right? But it also means your entire risk profile has changed and you didn't even make a decision. You're letting the market's whims dictate your strategy, not the other way around. The process is actually pretty simple, but it takes discipline. First, just set a schedule. Check in on your portfolio once a quarter. Second, have a drift rule. If any part of your portfolio drifts too far from its target, say by an absolute 5 or 10%, it's time to act. So in our example where crypto went from 5% to 10%, you'd move to step 3. You sell that extra crypto, and you use the cash to buy more of your stocks and bonds, bringing everything back to your original targets. This system forces you to take profits off the table and keeps you disciplined. We've talked a lot about what to do. Now let's talk about what not to do. Because believe me, the world of digital assets has some unique and tricky traps that can cause major financial and legal headaches if you're not ready for them. Okay, I need you to pay close attention to this one, especially for investors in the US. The IRS does not see cryptocurrency as currency. No, it classifies it as property. And that seems like a small detail, but it's a critical distinction because it means almost every single thing you do with it is a potentially taxable event that falls under capital gains rules. And this leads to all sorts of tax traps that can catch you by surprise. For instance, trading one crypto for another, like swapping some Bitcoin for Ethereum, that's a taxable event. It's not like exchanging dollars for euros. On top of that, if you earn rewards from things like staking, that's taxed as ordinary income when you get it, which is often a much higher tax rate. The bottom line here is you have to keep meticulous records of your cost basis, what you paid for every single fraction of a coin. It is mandatory. Wow, we've covered a ton of ground, huh? From the raw data and the portfolio models to the critical rules of the road. So let's just boil it all down into one final actionable blueprint that you can start using today. Here it is, your 3 steps. Number 1, choose the portfolio model that genuinely, honestly matches your actual risk tolerance. Be real with yourself here. Number 2, pick how you're going to hold it. Do you want the dead simple safety of an ETF, or do you want the total control of holding your own keys? And number 3, do this right now. Go into your calendar and set a recurring quarterly reminder to check in and rebalance your portfolio. Start small, get comfortable, and build your hybrid portfolio with discipline. So there you have it. The data, the rules, the action plan. The knowledge is all yours now. But here's the thing. Information by itself isn't enough. The real challenge isn't knowing what to do. It's having the discipline to actually stick with your plan through the crazy, inevitable ups and downs of the market. You've got the plan. The only question left is, do you have the discipline?